In a commercial loan, 5 units and above, there is often a fixed time period and a variable time period. It's like a variable rate loan in the residential world, but there are very few 30-year fixed loans in the multifamily world. I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. You know I'm passionate about your education. I can't say it enough. I say it at the beginning of every educational video. I'm passionate about your education. I'm passionate about you being educated so you can be a more successful investor, so you can make sound decisions about your real estate portfolio and who you want to be. The more education you have, the more successful you'll be, the more at peace you'll be, and the clearer you can be about having a portfolio that serves your long-term goals and your goals today. Very passionate about this. Did I say I was passionate about it? I'm passionate about it. So today I'm covering what I feel like to be a relatively simple question that I get asked a lot, but let's take a minute to give you an answer. What's the difference between a commercial loan and a residential loan? I've only owned single families. I'm now going to buy a 5 unit, a 12 unit, a 15 unit, a 30 unit. How is my loan different? The loans are different. And let's talk about how a commercial loan on a multifamily unit is distinctly different from a residential loan of 4 units or less. The first thing that I want you to understand, because to me, this is the biggest lynch point between the two, is a residential loan, a conventional 30-year loan on 4 units or less, generally has the same, or you can get the same interest rate across, and therefore, and the same payment across 30 years. Same interest rate, same payment across 30 years. The value of that, and this is a deep, deep value, is as your rents increased, your loan payment does not. As the value of your property increases, as the economy gets stronger, the value or the cost of your loan does not change. So if you're good at being able to increase your rents every year, 3%, 5%, 8%, and you're good about maintaining your expenses, being able to upgrade your building, whatever it is, if you're good at managing your building and therefore your rents continue to increase every year, or the economy has forced growth, especially in Southern California, on your rents due to demand, or on the value of your property due to demand, your payment for your loan stays the same. I happen to like that security. I happen to like that the more my property grows in value, I get to keep the increase. I'm not paying it to the bank. In a commercial loan, 5 units and above, there is often a fixed time period and a variable time period. It's like a variable rate loan in the residential world, but there are very few 30-year fixed loans in the multifamily world. Usually they're fixed for 3 years, 7 years, 10 years, even though it's amortized across 30 years, because they're assuming an amortization or a payment across 30 years, but the rate, the interest rate, and therefore the payment only stays fixed for that number of years, 3 years, 5 years, 7 years, or 10 years. So I kind of don't like that. Like, wait a minute, hold on a second. You mean when it becomes variable, I could literally have my interest rate and my payment reset every year, and my payment that I have to pay out might go up, and I don't control that? I don't know about you guys, but that makes me nervous. Like, it literally makes me nervous. I'm like, I love 30-year fixed. I can understand what my payment's going to be, and every time the building is more valuable, I get to keep all of that. Every time I get higher rents, I get to keep all that. But if the interest in the economy, or the lending rate, the intra-bank lending rate, has increased, my interest that I'm paying on my loan increases too. So that to me is like, ooh, juice. What about the 80s when we had Reagan? We were in double digits interest rates, 12%, 18%, I think was the top. What do we do with that? Now, so that's one. What is it that allows these interest rates to vary, to change? They're usually based upon what's called an indice. And concept two, the interest rate's usually based upon an industry. The T rate, right? The Treasury bill rate plus 3%, right? Treasury bill rate plus 2%. That's generally how the rate is written inside of the agreement of the loan paper you're signing on these commercial loans, is that it's tied to an industry. Generally, it's the T-bill, but it might be the LIBOR. And those rates do move as inflation increases, as the interest rate increases, as the intra-bank lending rate increases. Those industries generally increase, and therefore your payment will increase if you're in the variable part of your loan. Okay, now how do I control that? Because again, I'm not happy. This is changing on me, that I'm not comfortable with this. How do I control this? Okay, the way you control it is what's called a floor and a ceiling. In most commercial loans, they have a floor interest rate and a top interest rate. And they have a regulator, you can think of a car regulator if you want, they have a regulator on it that defines how fast they can increase the interest rate. So my floor is usually the interest rate I'm getting the loan at. If I got the loan at 5.5%, generally that's as low as the interest rate will go on the loan, regardless of the T-bill, the LIBOR, or the margin that they've stated. If it's 5.5%, and the T-bill plus the margin ends up being 4%, they're not going to go below that because that's the floor of the loan. But the other side is there is also a ceiling. They can increase on a regular basis, which is defined inside of your loan agreement. They can increase the interest rate every so often, but there's a point where they can't go past 8%, 9%. That is your ceiling. And it is inside of your commercial loan documents. When I buy a building, and I'm looking at the loan on the building, I will run the numbers on the building, income, expenses, cash on cash return. I'll run the numbers on the building and the cash flow on the building based on the maximum or the ceiling of that particular loan to make sure that if all of a sudden, it's not going to happen all of a sudden, just saying it doesn't happen that way, but if all of a sudden my interest rate went from the 5.5 floor that I have currently booked the loan at to the 8% ceiling that's written in my documents, what's going to be the effect for me as an owner on the cash flow of that building? Most important to me is, am I going to have to put cash into the building to sustain it? That's what I'm looking for. At the ceiling rate, interest rate, would I need to put cash in the buildings to sustain it based upon today's rents? That's my acid test. And can I live with that? Now, the chances of that happening are incredibly slim. Here's why. One, generally, you have a fixed period, 3 years, 5 years, 7 years, 10 years. So you now have rent growth in front of you for those in that fixed period. So it's not going to be today's rates. It's going to be the rates in 3 years, or your rents in 3 years, 5 years, or 7 years. So it's not going to be today's rents. It's going to be the future rents. That's one. Two, generally, there is in your loan agreement stair steps as to how often they're allowed to increase it. Might be once a year, might be once every 6 months. They are allowed to increase your interest rate. And there's by how much it's allowed to increase. 1/4 of a point, 1/2 of a point. So if it's 5.5% and I've hit the end of my fixed period, now I'm variable. And once a year, they're going to reassess my interest rate at 5.5, even if in that 3 to 5 year period, my fixed rate period, interest rates have gone to 10%, they can only increase me that year by 1/2 point because that's the agreement. So I go from 5.5 to 6. And a year later, if interest rates are still 10%, they can only take me from 6 to 6.5. So it increases stair steps each time period where increases are allowed. Obviously, a year is less volatile than 6 months. It takes longer for them to jack up to the ceiling, every year with a 0.5 point increase than every 6 months with a 0.5 point increase. That's considered, obviously once a year is to me considered less risky because it takes longer for them to be able to get to a maximum interest rate or the ceiling interest rate. Those would be my preferences. So my preferences, because I am a conservative investor, I've invested for 30 years, my preferences is to have a longer fixed rate period if I'm going to own the building as a rental unit for a longer period of time. If I'm going to own the building for 5 years to rehab the building and then sell it, a 5-year fixed rate period is fine with me. But if I want to own it long term, then I would like to get a 10-year fixed rate period. But you pay for that. Generally, especially since 2000, the longer that you have your fixed rate for, the higher that interest rate is going to be. Because they're trying to anticipate where's interest going to go over the 10 years that this is locked in place. And generally the anticipation is that it's going to be higher. We've been at all-time interest rate lows, guys, as you know, for over a decade, if not almost 2. This is what created 2004, 5, and 6, and then created the Great Recession with these unusual, long sustained, low interest rates, pushed up the prices of real estate. And we still have, because of where we have been since the Great Recession, we still have unusually low, historically low interest rates available to us. So in general, it's going to go up, guys, not down. Interest rates, the interbank lending rate should go up, not down. Now, it might go sideways. We might go the way of Japan. It might go sideways. We also are potentially looking at inflation. We've already seen inflation of 3 point something percent in California just since, I think, May to May or April to May. My guest today on my show gave me that number of the CPI index increasing, right? The inflation index has increased. So generally, I like to lock in a longer period if I'm going to own the building for a longer period. If I'm going to rehab the building and my intention is to sell the building, then I'm happy to accept a shorter period, because what I want is the lower interest rate of the shorter period, the 5 years, versus the longer interest rate, the higher interest rate that generally a longer fixed period will bring you over 10 years. So I hope I've given you some understanding about commercial loans, how they differ from residential loans, why I actually, when people say they want to buy a 5-unit, 6-unit, or 8-unit, I'm a little like, would you be willing to think about a 4-unit? Because you're so close to a 30-year fixed loan that would allow you to have less variability, you might want to consider it. But if you want to get a commercial property, which I love, and I've owned many of, understand how a commercial loan works. There are fixed time periods. They generally have a variable interest rate after that fixed time period. They are based upon an indice, which will potentially move up and down the T-bill or the LIBOR. And there is a floor and a ceiling, and the stair step on increasing, which is the best way you can control your loan, is negotiate those terms as favorably as you can, because loans will go, because generally, given today's low interest rate environment, your interest rate will probably go up and not down. I hope this was clarifying. This is Christina Suter with the Real Estate Breakthrough Show. You can find us every day, 24/7 on iHeartRadio, Roku, and iTunes. You can also find us on Roku and Amazon TV. I think I said Roku twice, but that's okay. You guys can handle it. Talk to you next week.